This podcast is intended for investment professionals only.
Hello and welcome to this CIO market update from LGIM. I'm Max Julius, Head of Content, and I'm delighted to be joined by Sonja Laud, CIO, and Tim Drayson, Head of Economics here in London. And we also have Jason Shoup, CIO at LGIM America, with us from Chicago. Hello, everyone, and welcome to the pod.
Hello.
Hi.
Hello.
We've gathered today to dig into the outlook for the US as market volatility is ticking higher and risk assets are edging lower following a spate of central bank decisions and commentary, not least by the Federal Reserve. Sonja, before we shift our focus to the other side of the world, I know you've just been to our new office in Singapore. What's top of mind for our clients in Asia? And has the visit altered your perspective on the overall investment landscape?
Great. Thank you, Max, and a very warm welcome to our listeners. I have indeed been in Asia last week in Singapore and Hong Kong. And as you just said, Max, we have very proudly opened our office in Singapore just now. And it's been really interesting and very exciting, lots of buzz in the region. And I have to say, I haven't been since 2019, so pre-COVID. And it has been great to be back. Now, not surprisingly, the focus is very much on China. They are obviously far closer to the events. They normally have higher exposure to China through either equities or credit. And as such, what's currently happening obviously takes a much bigger toll on regional investors. And as we've discussed on previous podcasts, China currently is going through a balance sheet recession. A decade of overinvestment in the real estate sector is now coming to an end, and we have to work through the excesses and we have to work through the overhang. The reason why I'm stressing this is because the sentiment clearly is very negative. But the question is, will the government step in with a stimulus that is large enough to turn the sentiment and obviously support markets? And that here it is important to understand, because a balance sheet recession means that stimulus will not work in the kind of common way that we would expect. So it can smooth the process, it can help, but obviously, working through the excesses and working through the inventory, in particular in the real estate sector, is something that you can't necessarily help with big stimulus. On our estimates, there's roughly 3.5 years of inventory, and it gives you an indication that it might take some time before we're seeing the bottom with regards to the economic development. But clearly, given that sentiment is so negative, we shouldn't underestimate the chance for a bigger than expected stimulus and at least a temporary relief rally in markets. And it's important then in that context to have a look, because the gap is big between Chinese equity markets and if you look at the Nasdaq and the S&P. And this is why, not surprisingly, there is a more negative sentiment in Asia, because the more exposure you had to Asian equity markets or even to the bond market, the more you obviously now feel probably more negative on the overall outlook. Interestingly, to the contrary, India gets equally a lot of attention, because obviously India is currently the best performing large global economy. And hence investors are very interested to see how they can get exposure there. And what has coincided with my visit last week in the region is actually India's inclusion in the JP Morgan Emerging Market Bond Index. So a very important milestone. So very interesting, the contrast between those two big countries. But clearly it seems that India might get a lot more attention going forward, in particular under the assumption that it will be the third largest economy in the world by 2030, assuming an annual growth rate of around 5%. Now, apparently, I've been told there's even more bullish scenarios, but it remains to be seen how they can put those policies in place, because it's a very unusual economy. They're quite service heavy. And if you consider the success stories, and particularly in emerging economies, is normally manufacturing-led, not services-led, because you have to wonder how you create all the jobs for a population of 1.3 billion in order to obviously move forward and create even more a more dynamic economic backdrop than they currently have. So quite interesting from those two aspects, but they obviously are not immune to what's happening in the US. And so this is the nice segue to talk about the US, because the Fed meeting, the last one, and I know Tim will talk about this in more detail, clearly has led to higher yields in the US and elsewhere. Why is that important for the region? Because the higher dollar has a direct impact on local currencies. And if you look at the yen or the renminbi, they have suffered quite a bit. It obviously means as well that local central banks will not probably be able to cut rates as early as they'd anticipated. And we should recall they were ahead of developed market central banks. They were early in hiking rates, and obviously hence would probably feel more in a position to support through monetary policy, but kind of can't, because obviously they're importing to some extent US central bank policy. This is why the Fed still is so incredibly important in the region, gets a lot of attention, and hence obviously whatever Powell is sharing with the market, and in particular this idea around higher for longer, does get a lot of attention because it will have a direct impact on the region as well. So again, more focus obviously on what is happening directly in the region with India and China, but at the end of the day, they will be very dependent on how the US is working out, and in particular how central bank policy will influence the trajectory of the economy.
Thank you, Sonja. That's a really useful overview. Of obviously sets up Tim very nicely to talk about the US. So some big questions about China and Chinese assets, and as well for the broader EM complex, and of course with asset allocation implications. Well, Tim, we're at the end of what feels like a momentous month for central banks. Are peak rates finally in sight?
Well, Max, we could be there in all three of the Fed, ECB, and Bank of England. But let's not celebrate prematurely. After all, monetary policy operates with long and variable lags. And for much of this tightening cycle, which has been extremely aggressive, markets have believed that central banks have probably reversed course fairly quickly. And that's led to curve inversions and lower than you might have expected long-term interest rates. But more recently, we've had a couple of developments. So the first is that expectations for those rate cuts have been pushed out further into the future. And that's partly due to better than expected growth in the US, and in Europe, probably more to do with sticky inflation and the central bank telling us that it's in no mood to cut rates anytime soon. Second, and perhaps a bit more worrying, it looks like a term premium is creeping back into markets, and this could be linked to the widening US fiscal deficit, which has been a big surprise to us this year and is one of the main drivers of the positive growth numbers. So, that could be getting some attention from the bond vigilantes.
Thank you, Tim. That's a very clear answer. Too soon to celebrate, and perhaps while we've all been focusing on monetary policy, fiscal is obviously a critical part of the picture. A quick follow-up question, which is what does all of this mean for the global economic outlook? And in the US, should we expect the soft landing that the Fed is forecasting?
So here's the paradox. The Fed came out with very optimistic forecasts around a soft landing. Up until the last week or so, markets were beginning to buy into a soft landing narrative as well. But the consequence of that has been to push up long-term interest rates. And for me, that actually makes a recession more likely next year, as we've got even higher and restrictive monetary policy. The US has been pretty resilient over the last year, whilst Europe's been teetering on the brink of recession. But I think there's a number of temporary factors which have driven the positive outcomes in the US, and a lot of them are about to go into reverse. So I see several headwinds, and that's even if we kind of get through some of these near-term potholes around auto union strikes and potential government shutdown. So things I'm looking at include an exhausting of the excess savings, which households have been spending down since the pandemic was over. We've got the resumption of student loan repayments, which will take a few tenths out of household disposable income. We're seeing higher energy prices. Just before we came into this pod, new kind of local highs now. This is going to lead to higher headline inflation and squeeze real incomes. And then the fiscal side, which we've been talking about, unusually massive support for this point in the cycle, but about to go into reverse, both at the federal level, given the agreement with the debt ceiling to actually curb spending, but also state and local governments being on a bit of a spending splurge, and that's about to stop. So if you look at those factors individually, they're probably not sufficient on their own to cause a recession, but if you combine them alongside these higher interest rates, that would give me a base case of recession next year. Once we go into recession, I think the Fed will then eventually cut rates, but it can't cut preemptively here. It's very different from previous cycles because there's still this inflation constraint. It's only when the recession is kind of very visible and we see unemployment rising, then the Fed will be in a position to loosen the shackles.
Okay, a loosening of the shackles, right? Well, look, thank you, Tim, for talking through those dynamics, and it's a great point at which to bring Jason into the conversation. Jason, we were just saying this is your annual outing on the podcast. Welcome back to the pod. In light of the macro environment that Tim has just outlined, where do you see the biggest market opportunities and risks for investors?
Thanks, Max, for having me back. Strangely, it's possible that we enter next year with sort of a very similar level of macro trepidation as we entered 2023 this year, right? We know that recession risks have been sort of pushed to the out in the calendar, and it feels very much sort of like a similar entry point from a macro perspective for markets. But maybe the key difference is that the sort of valuations across asset prices are in a totally different place today than they were 9 months ago when we were entering January. To us, it looks like soft landing is very nearly fully priced everywhere we look. You could even make the argument, just as Tim did around just a minute ago around the term premium, that no landing is maybe starting to creep its way into some corners of the market too. So I think the big and the obvious risk is that we don't get a soft landing. We don't get no landing. We get something a little more severe than that. And that's probably the main sort of front and center issue facing us. Where are the opportunities? I think all that said, it's correct to think that even in a more hard landing scenario or even a soft landing, that we don't believe that the Fed is going to cut all the way back to zero again in the near future. And for that reason, the front end of fixed income looks like an opportunity that's going to persist for some while. Obviously, at the minute with the Treasury yield curve inverted as it is, it looks very attractive to be in the very front end of fixed income. But I think it goes beyond that. I think we see plenty of opportunities to sort of add front end carry and front end fixed income into portfolios, more structurally for a medium kind of term horizon. Securitized markets, for instance, have not rebounded nearly as quickly as we've seen corporate credit markets do. Meanwhile, I think sort of turning attention slightly, I think a lot of investors have viewed longer end rates as a hedge against a slowdown, but they were in the trade really early, right? And as recession calls have started to been delayed, we're now starting to see that term premium reappear as Tim described. I think, not to be too cute about it, but I think if you liked 10-year treasuries at 3.5% 6 months ago, you're supposed to love them now above 4.5%. The one nuance I would have that I would point out is that it's really been the real yield that's climbed higher and looks like the best value to us in this market, not necessarily the nominal yield that you get from just purchasing a 10-year treasury. So that's probably the biggest opportunity from a hedging perspective out there, sort of getting long real yields at these levels further out the curve and sort of arguing that these are levels at which historically the U.S. economy has struggled to sustain growth at trend or above, right? Exactly what Tim is saying there, that as the term premiums grow, paradoxically, the risk that you get a recession also grows along with it. And at some point, there's going to be a really good entry point to express in real yield space.
Thanks, Jason. It's really striking to think when you talk about the level of yields at the front end of the curve that on this podcast only a few years ago, we were talking about how to navigate negative yields. Well, look, of course, the US market is the most covered worldwide, but you're out there on the ground with intimate local knowledge. Is there anything that global investors are not paying enough attention to?
I guess I have two things that I would point to. One is that maybe it's obvious given our conversation so far, but within the fixed income world, the entire fixed income community has sort of moved to yield as the primary valuation metric, right? And it's dominating other alternatives we have to evaluate fixed income asset classes. One corner of fixed income that seems to be really, really in the crosshairs these days is the long end of the U.S. investment grade market. So that's the 30-year bond market for corporates, right? And there's sort of been a double whammy that's hit that segment of fixed income. On the first would be that supply has really just fallen off a cliff. So maybe not surprisingly, but corporate CFOs have been very reluctant to go out and issue 30-year debt in an environment which is perceived to have very high yields, right? And this latest leg higher that we've seen, the term premium being reestablished at the back end of the U.S. curve, has really been just another nail in the coffin. And you're getting year-on-year sort of issuance in that segment of the market being down upwards of 30 to 40%. The second sort of factor, the second whammy, if you will, is that those higher yields have also attracted new buyers of the long end of the corporate market. So you have life insurers and foreign demand increasing this year, very attracted by sort of 6% or north investment grade, long end debt. And the result of both of those technicals is the way I guess we'd call it, is that spreads have at the back end of the curve gotten very, very narrow and very, very rich. So really, that's one dynamic that we are, trying to think about. How do we create solutions and portfolios around? How do we, not lend money to corporates where the vast majority of the compensation that we're receiving is just the risk-free rate, right? It has nothing to do with any cushion for corporate disappointment, downgrades, defaults, and the like. That's one reason why we really like the front end of the market far more than we like the back end of the market. The second sort of thing I would say that's worth keeping an eye on just much more broadly is as you move down the credit quality spectrum, as you move into high yield leverage loans and sub investment grade borrowers, there's clearly been in this cycle a blurring of the lines between these asset classes. And probably the thing that's very different this time around is the availability of private capital and the ability to see leverage loan borrowers or high yield borrowers use that capital to refinance and to kick the can down the road in terms of ultimately running into trouble with the cost of their debt. For that reason, it's probably not surprising to see that while the macro has been very challenging, that how that's translated into defaults or to downgrades is running below what our expectations would have been, right? So in this type of an environment, I think we would have expected a lot more corporate stress sooner. But all of this private capital in these parts of the market that are really hard to keep tabs on and to follow have really been making their presence felt. And the question is, for how much longer can that persist and really cushion the downside in credit markets?
Well, thanks, Jason, for lifting the veil on those particular dynamics in the US market. Sonja, since we spoke about a month ago, risk assets have continued to soften. If we really are close to peak rates, shouldn't investors be in store for a big rally in equities?
No, it is a good question, but following to what Jason has already mentioned on valuations, it's very clear that equity markets, again, very similarly, are not pricing any downturn yet and are far more aligned to the soft landing or even no landing. So if we look at on our indicator in terms of the recession pricing, we are far away. And therein lies the risk, because clearly equities have been supported by the more resilient and actually quite buoyant US economy. And again, as I said, it is difficult to generalize here because the US is the outlier. We have seen positive European equity returns, but as I've just said right at the beginning, clearly the image is very different in Asia and some of the emerging markets. So it's not been a homogeneous picture that we have been seeing, but generally it is because the economy has been more resilient, and as such, earnings revisions have held up better than we would have expected at this point. Now, you're right to say that normally we would expect equity markets to trough ahead of the economy. So you really want to get your timing right here. But given that we haven't made the adjustment yet to fully price a slowdown, we feel that the risk reward at this point is not particularly attractive. Now, again, there will be differences in sectors, there will be differences in regions, as Tim has outlined earlier. Clearly, Europe is far closer to a recession already. The signals that we get from the underlying economic indicators is far more negative. But again, if you look at the overall valuation levels and the market reaction, and as you quite rightly said just now, we've only seen a softening so far. What was interesting is that clearly we have seen some acceleration on the back of yields moving higher on this higher for longer idea, and obviously a reduction in the expected cuts in 2024, because what equity markets would look for is the journey and the trajectory into 2024. But with that now shallower, i.e. higher rates for longer, you clearly have more pain that will be inflicted on the economy. And as I said, most importantly for equity investors is earnings revisions. Now, you can clearly start looking for opportunities because there will be structural drivers. And again, I've always liked to highlight, if you looked at the S&P, 495, and not the S&P 500, the picture is very, very different. So be mindful not to extrapolate from headline levels what indices are telling you, because we've had a very, very uneven development across sectors. And clearly the AI topic has been so dominant across the US market that it is important to understand whether this can continue. And obviously, particularly if you extract those valuation levels, then even the underlying headline is lower than what we currently look at. But I know we have been early with our call-in on this, and it's clear that overall we are underweight risk because we see more potential in government bonds. But clearly we will stick to it because we feel that valuation levels are not commensurate with our view on how the economy will unfold.
Thanks, Sonja. So all eyes on earnings, and we need to dig beneath the changes at the headline index level. Jason, US politics is heating up, as it often does, ahead of next year's presidential election. From a purely markets perspective, what should we be watching for?
Yeah, it's been an interesting, political calendar over here, and it looks like it will continue to be all into next year. Probably worth saying that before we even turn to the election, we really need to navigate the possibility of a government shutdown in the next week, right? And it's becoming clear that it's very difficult to navigate the Republican-controlled House at the moment and get any legislation. I'm no expert exactly on how that's going to unfold, but I would flag a few things. One, probably the most important and likely to be confounding to Tim over there, is that it's very likely that if the government is shut down on Sunday, that there won't be any data available for the Fed to base its opinions on the economy at their next meeting, right? And you're already starting to see the rates market potentially take this into consideration. And if there is indeed one more hike left in this Fed's arsenal, they might be unwilling to do it in November if they can't see a jobs report and they can't see a CPI report right ahead of that, because the government isn't paying the bills to go conduct the surveys. So that's probably the most important element there. There is a potential for another downgrade to the U.S. government coming from Moody's. I don't think that will be all that important as things go, given that 2 out of the 3 rating agencies already have the U.S. government debt at AA+. I guess first and foremost, we have action before the end of the year to kind of see how it plays out. Turning to the election, I think fundamentally different election year, same politicians and maybe same risks, right? Thankfully I can kind of look back at my notes from 3-4 years ago and steal a little bit. The biggest risk, I think, from markets perspective is always and will continue to be, what if one party can sweep all 3 branches, right? And I think this election cycle somewhat favors, from the starting point of more than a year out, somewhat favors a divided outcome still, regardless of which way the president goes. The president, the top of the ticket goes. It looks like, each party is in a, relatively better position to hold or see their current holdings flip in terms of control of the House and the Senate. So not too much risk that those end up moving in the same direction. You'd think, though, that this rise in rates and these larger deficits that we've been highlighting would, maybe start to change the risks around a sweep, right? That are big concerns whenever you see one party gain control of all the levers, is that they are able to, potentially run higher deficits, to really focus on their own spending priorities, to either cut taxes or look at more governmental programs, and that some of that should be constrained by the fact that the cost of interest and satisfying that interest on an ongoing basis has risen quite dramatically in the U.S. I think my guess is that, again, if either party manages to pull off that unlikely sweep, that all of that will be forgotten for the time being, and that deficits will be not a major concern. But it is true that you're starting to see some politicians once again reemphasize fiscal conservatism in the U.S. and overspending. So that's something worth watching. I would say, particularly if you get, Jamie Dimon's risk scenario of the Fed having to go to something like 7%, we're definitely, on the precipice, if not past it, the point where, interest expense on U.S. debt starts to crowd out other priorities and other spending priorities. And it would only get, that much worse, if the Fed had to raise rates even further. Couple more points. It's probably right to emphasize how little we know at this point of the election cycle relative to past years. Both parties are fielding a candidate at the top of the ticket that has very high unfavorability ratings, and major concerns as to whether they'll actually be the candidate in 2024 for different reasons, health, legal, etc. There are plenty of alternative candidates in the wings, but it seems like something would have to go wrong at the top of the ticket for sort of to change the idea that we're going to get a Trump-Biden showdown once again. And then the final thing I would say, very trite, it's the economy, stupid, right? Right now, the sort of success that the Fed has had in bringing down inflation isn't really translating into any voter optimism for Biden, right? He's getting no credit for the jobs created this year, the recession potentially avoided, or that move back from very elevated inflation in the U.S. Things like very high mortgage rates, the cumulative cost of living, the rises that we've seen over the last few years, even just gas and food prices are all weighing on popularity for the incumbent administration. Maybe this only needs time, and eventually consumers will start to realize that their costs are a little bit more manageable as time goes on. But maybe 2024 is going to be dominated by a recession, right? At some point unfolding too. in which case keeping the economy more functioning throughout 2023 at a higher level of growth could prove to have been politically unwise, because a recession in the year of an election is no great recipe for getting reelected if you're Joe Biden. So, where did I boil that down to? Probably the two biggest things to watch are just the price of oil, because that has a huge, effect on consumer sentiment, and unemployment, and in which states we start to see unemployment rise. So again, for all the machinations in U.S. politics, it's probably focus on the economy is probably going to dictate the biggest outcome.
Thanks, Jason, for that really valuable insight and perspective there. And we'll definitely check in as the political situation in the US evolves. I'm sure it won't confound Tim at any point. Well, Tim, is there anything you'd like to add to Jason's comments there? And as we look ahead towards year end, are there any other macro uncertainties keeping you up at night?
Jason did a great job running us through the political uncertainties. Maybe if I just throw kind of a couple of data points around the fiscal situation. It's somewhat confusing because of the accounting for student loans. But if you strip that out, the US federal government is running a deficit over the last 12 months of around 7.5% of GDP. Now, this is at a point in the cycle where the US, if anything, is operating above full capacity with an extraordinarily tight labour market. So the structural deficit could be even larger. So I think Jason's absolutely right. If you get a clean sweep, they've got the levers of power to maybe do stuff and deficit spend, but it's going to be a lot tougher from this starting point. So we can't really have a repeat of the Republican Trump administration where they cut taxes but didn't reduce spending, and then Biden Democrat administration raised spending but didn't raise taxes. So got two big deteriorations of the deficit. It's going to be a whole lot harder moving forward, and particularly with this ratcheting interest cost expense on the debt as well. I think that's going to feed into the popular discussion. In terms of what's keeping me awake at night, I mean, gosh, if I went to bed worrying about all the macro risks, I would never get to sleep. We've covered quite a few of them. I mean, Sonja talks about China and the balance sheet recession. We mentioned between us energy prices. For me, it's maybe this kind of swing from the Goldilocks narrative back to stagflation. So we've kind of oscillated between the two, a brief flirtation with Goldilocks over the summer. I think growth is going to slow. But maybe inflation doesn't come down as quickly as hoped. The initial reduction in inflation was really driven by the unwind of the supply chain disruptions. We're still left with a more persistent underlying dynamic, and that might require a kind of bigger shakeout in the labour market. And that's a part which will be much harder for central bankers, because whilst inflation was high but unemployment low, they could focus entirely on tackling inflation. But if unemployment starts rising, then you start to consider the trade-off between the two, and that becomes much more of a challenge.
Thanks for that, Tim. Sonja, we've covered a huge amount of ground today, as we do every month. What are the key takeaways for investors?
I think we have indeed covered a lot of ground and a lot of facts. And I know that, and that was actually feedback from our trip to Asia as well, that clients rightly are to some extent confused and probably are shying away from making big investment decisions, because there is probably more clarity on the near-term narrative up to a year, because we now have, as we discussed around it, the balancing act between rates and inflation and the economic growth outlook. And as such, obviously, probably a clearer picture around how this marries up with valuation and where you might have higher risk in your asset allocation. Now, that's as far as clarity goes, and it's very clear then if you try to consider longer term implications, in particular the implication of debt sustainability, fiscal sustainability, and how this should be balanced, and the implication particular for fixed income and rates. That is point number one. And this is even before we have then included bigger structural drivers around the relationship between the US and China. We have mentioned both of them, but more from a near-term context, not necessarily from a long-term context. I thought, and as I mentioned right at the beginning, the implication how India might fit into this, clearly on a growth trajectory that warrants greater attention. They've clearly made their mark in terms of the G20 and the hosting and the way how Narendra Modi tries to position India in that context. So again, is a structural shift that clearly companies will take note, investors will take note, and again, provide risks and opportunities. And I think investors are well advised to start to consider how those long-term drivers can impact their current asset allocation way beyond the immediate, trade-off between, oh, do I have too much risk in my portfolio and do I need to tweak just for the next 12 months outlook? I think the longer-term understanding of the real drivers of risk and return is very important to reflect.
Well, that is a very important point on which to end today's call. Just before we go, I'll ask you all the question with which we usually end this podcast, which is what you've been watching, reading, or listening to recently. I'll get the ball rolling and say I've been reading Wolf Hall by Hilary Mantel. It's a historical novel all about Henry VIII and his wives, and it's fantastic. Tim, would you like to go next?
He's throwing me with this question, but I've been watching this rather horrific sci-fi box set on Netflix, which actually makes one feel a lot better about the world.
Okay.
It's so horrendous that actually what we're going to today is madness.
Oh, sounds very.
It's called From.
From.
Yes, quite scary.
Good to know. Sonja.
Less scary, but really fascinating. I have been, and I'm still reading, a book called 4,000 Weeks by Oliver Berkman. And it is, so the subtitle is Time Management for Mortals. And it is looking at the fact how time became an abstract thing we seem to believe we can manage, and clearly is causing a lot of stress because we all always believe we're running out of time and there's only 24 hours in a day. It's very nicely written, and I have actually read it on the long haul flight to Asia, and it's just a good way to reconsider some of the ways we think about our lives and how we are structuring it.
Thanks. So a different vibe to the sci-fi from Tim. Jason, what have you been consuming recently?
It's a good question. I've been embarking on this quest to try to watch all the shows from various streaming platforms so I can cancel my streaming platform. Okay. Right? Because I feel like I have too many. So I've been doing the Apple TV one lately, and I've been working my way through. I'm with Tim. I've been watching a show called Invasion, which is aliens and the like. Keeps me up at night. Probably not the wisest thing. Ends up with messing with my time management to Sonja's point. But the funny thing is the streaming platforms, they always have one more show that keeps you from canceling that I don't have time to get to. So I'm losing that war myself, if I must admit.
Yeah, thank you. In a business model, perhaps we can dissect on a future podcast. Well, look, with that, thank you, Tim, Sonja, Jason, for your time today. We've had a very eclectic mix of recommendations at the end there. Our next edition of this podcast will be in late October, when Sonja will be joined by Anand Venkatramanan and Rob White to discuss our CIO Autumn Update, which will be devoted to the theme of artificial intelligence. In the meantime, you can find our latest updates via our social media channels, on the LGIM blog, and of course here on LGIM Talks.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. This podcast should not be taken as an invitation to deal in legal and general investments. Any views expressed during this recording belong to the individuals and are based on market conditions at the time of the recording and do not reflect the views of legal and general investment management. Forward-looking statements are, by their nature, subject to significant risks and uncertainties and are based on internal forecasts and assumptions and should not be relied upon. Where individual stocks are mentioned, these do not constitute a recommendation to buy or sell any security and are for illustrative purposes only. Legal & General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. For full terms and conditions, please visit our website. To find more content, you can check us out on Twitter, LinkedIn, and our website. Copyright 2023. Legal & General Investment Management Limited. All rights reserved. No part of this publication may be reproduced or transmitted in any form or by any means, including photocopying and recording, without the written permission of the publishers. This material is issued by Legal & General Investment Management Asia Limited, the Licensed Corporation BBB 488, regulated by the Hong Kong Securities and Futures Commission, for professional investors only.